Assalamualaikum warahmatullahi wabarakatuh, guys. Welcome back to our analysis of the Islamic banking profitability. The questions here is about the Malaysian bank. Are they making too much profit? Of course, it is much welcoming to see that the banks are healthy and remaining solvent, and the positive earning, of course, will increase the GDP. It will contribute to the employment creation and value addition, and the mobilization of capital, in the business. So that will be one of the positive role of the financial service provider, to see that companies, individuals, are able to have access to the financing product for them to expedite their respective transaction. But then one of the issue that we need to share here is about the role of capital in banking. So meaning that we can see from the earlier videos, we can see that Maybank, CIMB, and Public Bank were enjoying high earnings. For Maybank, they were making more than 9 billion ringgit last year. CIMB and Public Bank both were making more than 6 billion in 2023. And of course, this net earning, this high earning will further strengthen the capital base of the top three banks. And that is why it is very critical to see that the banking capital is preserved and not destroyed. Because if the bank is not making profit but making losses, so these losses would be absorbed by banking capital, and that will cause trouble to the country, because if many banks are making losses and becoming insolvent, then there wouldn't be any entity that will be able to provide the liquidity required by businesses and so on. So it is very important to see that capital is preserved and not destroyed. So in order for the bank to ensure sustainable capital accumulation, the bank must make safe and prudent loans. Okay, so for conventional banking, we can refer to loans as the banking product offering. And for Islamic banking, we can refer to murabahah or tawarruk. So we will be using these terms interchangeably because the banks in Malaysia, both Islamic and conventional, they are operating side by side. And therefore, so we need to use this jargon carefully so that we will not confuse the listener. So when I say loans, so this are referring to riba loans or interest-bearing loans. And when I mention murabahah or tawarruk, we are referring to sale as opposed to loans. So this need to be we have to be careful in using the terms as we go along. So in order for the bank to make safe and prudent loan, then we can say that the bank must possess a robust risk management process. So meaning that before the loan is issued, before the bank, give you the letter of offer, or before the loan approval, the bank must conduct what we call the risk management process. So this process will, first identify what are the risks associated with the loans or murabaha, and this process will also quantify the risk or the danger so that we are able to price it accordingly. So what will be the finance charges, on the respective exposure. And lastly, there must be a way to mitigate the risk. So meaning that if we agree to accept this loan, so we must be able to mitigate the risk. That is, how can we minimize the danger of default arising from this loan the bank offer to the borrowing public. So this is very important that when we talk about profitability, so banking profit will mean that some of the profit will be added on to the existing capital, and we can see some kind of capital accumulation or capital expansion, and that is basically what you want to see taking place in the banking business, that banking capital will be increasing over time. Right. So if you look at the cases here, what kind of impact on banking capital based on the type of loan the bank is making. So for example, in case A, when the bank make a prudent loan, so the loan has been assessed or have been assessed by the loan department, and in a sense that the loan is a prudent loan because it is well collateralized. So when the loan is supported with enough collateral or guarantors, let us assume that the risk associated with the prudent loan is at 10% risk weighting. So the risk weight attached to the loan is 10%. So meaning that, of course, this is not a loan that we gave to the government agency, where, for government to take loan from the bank, of course, the risk weight will be zero because there's no way that the government will default on the loan. But for ordinary individuals and business entity, there's no way that the RW will be zero because there will be possibility that this entity may default on their loan obligation. So we give it like a risk weight of 10%. So meaning that a big component of the loan is supported with collateral and guarantors. And if you look at the idea here, that if capital is equal to 50 billion and the earning generated from the loan funded by deposit is 10 billion, so meaning that loan will generate interest expense and the deposit will incur interest, the loan will generate interest revenues while the deposit, will incur interest expense. So that will be the earning of 10 billion. So we call it net interest margin of 10 billion. Then the return on equity, would be 10 billion earning divided by 50 billion of capital. And that will be 20% ROE. So meaning that if the entire earning is added on to the existing capital of 50 billion, then we can see that there is a capital increase from 50 billion to 60 billion, and we have a solid case of capital expansion